This is the story of a bank that survived almost everything and then destroyed itself in a single weekend. It lived through the American Civil War, the crash of 1929, the Great Depression, and two world wars. It was more than 150 years old, one of the most powerful names on Wall Street. Then, in the autumn of 2008, it filed the largest bankruptcy in American history. The failure of Lehman Brothers did not just end a company, it helped freeze the entire global financial system. So how does a firm that endured for a century and a half collapse in a matter of days? Let's rewind to the very beginning. The story starts in 1844 in Montgomery, Alabama, far from Wall Street. A young immigrant named Henry Lehman opened a small dry goods store selling cloth, tools, and everyday supplies. His two brothers, Emmanuel and Mayer, soon joined him, and in 1850, the three of them founded a firm. They named it Lehman Brothers. At the time, the local economy ran on cotton, the most valuable crop in the region. Many farmers had little cash, so the brothers began accepting raw cotton as payment for goods. Soon, they were trading that cotton themselves, buying and selling it for profit. Almost by accident, a shop had turned into a commodities business. The brothers realized the real money was not in selling tools, but in moving cotton, and later, money itself. After the Civil War, they shifted their base to New York, the rising center of American finance. They helped set up a cotton exchange and later became a founding member of the New York Stock Exchange. Over the following decades, Lehman Brothers reinvented itself again and again. It moved from trading commodities into underwriting, helping young companies raise money by selling shares to the public. It backed retailers, airlines, and manufacturers, growing into a respected investment bank. This ability to adapt became its trademark and its pride. Lehman survived the panic of 1907, when banks across the country nearly collapsed. It survived the stock market crash of 1929 and the brutal depression that followed. It survived world wars, recessions, and the slow decline of the family that founded it. By the late 20th century, the last Lehman had left, and the firm was run by professional managers. In 1984, it was bought by American Express and folded into a larger financial empire. For a decade, the Lehman name almost disappeared inside a giant. Then in 1994, it was spun back out as an independent publicly traded company. Standing alone again, Lehman Brothers had to prove it could compete with far bigger rivals. And leading that fight was a man who would define the firm for the next 14 years. His name was Richard Fuld, though almost everyone on Wall Street called him Dick. Fuld had started at Lehman as a young trader and spent his entire career inside the firm. He was intense, competitive, and fiercely loyal to the company he ran. Colleagues nicknamed him the Gorilla for his aggressive style and his hunger to win. Under Fuld, Lehman set out to grow faster and take bigger risks than its cautious past. For years, the strategy worked beautifully. The firm expanded around the world and reported record profits year after year. Its stock price soared, and its bankers earned enormous bonuses. By the mid-2000s, Lehman Brothers looked unstoppable. But underneath the profits, the company was building the machine that would destroy it. To understand what happened next, you have to understand the housing boom. In the early 2000s, interest rates were low, and American house prices were rising fast. Banks were handing out mortgages to almost anyone who asked, including borrowers with weak credit. These riskier loans were known as subprime mortgages. On their own, each loan was small, but together, they were worth trillions of dollars. Wall Street found a clever way to turn these loans into products it could sell. Banks bundled thousands of mortgages together into securities and sold slices of them to investors around the world. As long as house prices kept rising and people kept paying, these products seemed both safe and highly profitable. Lehman Brothers went all in on this business. It did not just trade mortgage securities, it bought the lenders that created the loans in the first place. It acquired subprime mortgage companies, feeding its own machine with a steady supply of loans. Lehman became one of the biggest players in the entire mortgage market. For a while, this made the firm richer than ever, but it also tied Lehman's survival directly to the health of the American housing market. If house prices ever stopped rising, the whole strategy was in danger. And there was a second, deeper problem: leverage. Leverage simply means using borrowed money to make bigger bets. An investment bank uses a small amount of its own money and a large amount of borrowed money to trade. If the bets go well, the profits are magnified enormously. But if the bets go wrong, the losses are magnified in exactly the same way. By some measures, Lehman was borrowing more than $30 for every single dollar it truly owned. A leverage ratio of about 30 to 1 is extraordinarily fragile. It means that if the firm's assets fell in value by just a few percent, its entire cushion could be wiped out. Lehman was a giant balanced on a very thin base. For as long as everything went up, no one seemed to worry. Then, in 2007, the ground began to shift. House prices in the United States stopped rising and then started to fall. Borrowers with subprime loans began to miss payments and default in large numbers. Suddenly, those mortgage securities that everyone had wanted were worth far less than expected. Some became almost impossible to sell at any price. Lehman was holding a mountain of them. As the value of its assets dropped, its enormous leverage turned from a strength into a trap. The firm began reporting heavy losses, and investors started asking hard questions. The most dangerous question was simple: could Lehman survive? An investment bank runs on confidence and short-term borrowing. Every day it borrows huge sums to fund its trades, and every day it must roll that borrowing over. If lenders lose faith and refuse to lend, even a large firm can run out of cash within days. This is what makes a bank so different from an ordinary company. By early 2008, confidence in Lehman was draining away. A warning came in March when a rival bank, Bear Stearns, nearly collapsed. Bear Stearns was rescued in an emergency deal backed by the government and absorbed by a larger bank. Many on Wall Street assumed Lehman might be next in line for trouble. The pressure on Fold and his team grew intense. Critics argued that Lehman was slow to admit the true scale of its problems. According to filings and later investigations, the firm valued some of its troubled assets more optimistically than the market did. One accounting technique drew particular attention after the collapse. A court-appointed examiner's report later described a maneuver known as Repo 105. According to that report, Lehman temporarily moved tens of billions of dollars of assets off its balance sheet near the end of each quarter. This made the firm appear less leveraged and therefore safer than it really was, the report argued. The assets returned to the books a few days later, once the reporting date had passed. The examiner concluded this created a misleading picture of Lehman's financial health. It is important to be precise here. Lehman's executives were never criminally convicted over these practices. The debate is about decisions, judgment, and disclosure, not proven crime. But the effect was clear. When the truth about Lehman's weakness became visible, trust collapsed quickly. Through the summer of 2008, Lehman's stock fell further and further. Fold searched desperately for a way to save the firm. He tried to raise fresh money from investors, including funds in Asia and the Middle East. He tried to sell off troubled real estate assets into a separate company. He looked for a stronger partner, willing to buy Lehman outright. But every potential rescuer looked at Lehman's books and hesitated. The hole appeared too deep and the risks too large. Time was running out. That brings us to the most famous weekend in modern financial history. On the 12th of September 2008, top bankers and regulators gathered in New York. Officials from the Treasury and the Federal Reserve met with the leaders of Wall Street's biggest firms. Their goal was to find a buyer for Lehman before Monday morning. Two serious candidates emerged. The first was Bank of America, a huge American lender. The second was Barclays, a major bank based in the United Kingdom for a time. It looked as though one of them might step in and save the firm, but one by one, the deals fell apart. Bank of America turned away from Lehman and instead agreed to buy a different troubled firm, Merrill Lynch. That left Barclays as the last real hope. Barclays was interested, but it needed guarantees, and it needed approval from regulators in Britain. The British regulators refused to let Barclays take on Lehman's risks without a shareholder vote that could not happen in time. The private buyers wanted the government to help cover Lehman's losses, as it had helped with Bear Stearns. But this time, the answer from Washington was no Treasury Secretary. Henry Paulson and Federal Reserve officials decided they would not put public money into rescuing Lehman. They argued, in part, that there was no legal or political appetite for another bailout. Critics have debated that decision ever since. Some say the government should have saved Lehman to protect the wider system. Others argue that no legal buyer existed, and that a rescue was simply not possible on those terms. Whatever the reason, the outcome was final. With no buyer and no bailout, Lehman Brothers had run out of options. In the early hours of the 15th of September 2008, the firm filed for bankruptcy. It listed more than $600 billion in assets, making it the largest bankruptcy in United States history. Around 25,000 employees suddenly faced an uncertain future. Photographs of workers leaving the headquarters with cardboard boxes flashed around the world. A firm that had survived for more than a century and a half was gone in a single day. But the story did not end at Lehman's front door because the world's banks were all connected. Lehman's failure sent a shockwave through the entire system. Other institutions had lent money to Lehman or held its securities, and now faced huge losses. Fear spread that if Lehman could fail, any bank could fail. Lenders stopped trusting one another, and the flow of credit that the economy depends on began to freeze. Stock markets around the world plunged in the days that followed. Governments and central banks scrambled to prevent a total collapse of the financial system. In the United States, officials assembled an enormous rescue program to stabilize the surviving banks. The very bailout that Lehman never received was soon extended to save others. The crisis pushed the global economy into a deep and painful recession. Millions of people lost jobs, homes, and savings. In the years that followed, Lehman Brothers became the symbol of everything that had gone wrong. Its pieces were sold off in the aftermath. Barclays bought Lehman's North American business, and another firm took over much of its operations in Asia and Europe. The name that had lasted for generations vanished from the trading floors. So why did Lehman Brothers really fail? It was not one single mistake, but a chain of them. The firm bet enormously on a housing market that it assumed would keep rising forever. It funded those bets with dangerous levels of borrowed money, leaving almost no cushion for error. When the market turned, critics argued it was too slow to face the truth and reduce its risk. And when confidence finally cracked, the short-term lending that kept it alive disappeared overnight. The deeper lesson sits above any single decision. A business can survive for 150 years and still be destroyed in one, if it forgets how fragile it truly is. Lehman Brothers had endured wars, crashes, and depressions. In the end, it was undone not by the outside world, but by the risks it chose to take itself. And that is why Lehman Brothers failed.